Hi, thank you for the call. And so today, as you agreed, and you wanted to do a video call, then I will start again with some questions about Mintos shareholders. I've been seeing in like different comments in these Loan Originator pages, and in some there is a comment that about related parties according to IAS 24, and in some loan originators there is a comment about that some equity investors overlap. Can you maybe explain what are the differences there?
Sure. Well, first of all, hi. So it's actually a pleasure to kind of be here. And I think kind of video is usually kind of better means of communication than going in kind of endless email chats. So happy to kind of provide more insights to the questions you actually had to ask. So when it comes to the IAS 24 and equity overlap, actually, we have to look what is IAS 24. So IAS 24 is International Accounting Standard 24, which is defining what are actually related parties according to international accounting standards. So according to those standards, the related parties are only those companies where there is either more than 50% of the ownership in both companies. So if you have two companies, so in one company there's more than 50% and then the other. So you would say those are related. Or another threshold is that there's between 20 and 50% in each of the companies. So then those would be considered the related parties. If none of those criteria are fulfilled, for instance, there's ownership of, say, 30% in one company, but then 10% in the other company, then that's not a related party according to international accounting standards. So that's what we apply when we submit our annual reports, and that's also what we show to investors on the website. On top of that, so what, and that's just covered, so basically it means that if there's equity overlap below 20%, or there is the example I mentioned between, say, above 20% and in the other company less than 20%, then we would not have to show that as the related party. Okay. So what we came up with, just to bring it one level above and to provide this information to investors, we came with kind of our own term, which is equity overlap. So, and by equity overlap, we actually cover all those cases which are not covered by International Accounting Standard 24. So because if we would follow just International Accounting Standard 24, then we would actually report only 3 companies where there is equity overlap, because the others, technically, according to international standards, are not related.
So basically, in short, you'd say that this IAS 24 means that there's a really significant overlap, right?
Yes, so it's in both sides and it's significant. So while we have, for instance, on Mintos, we have where on Mintos there is some equity shareholding, and then there's more, say, significant on the loan originator side, and that would not be caught by the international accounting standards. So we provide additional information to investors.
Okay, got it. And then, but what's your threshold for this comment that some of the equity investors overlap? Because in some cases, there is no comment like that, but I still think that there is some shareholder overlap, like Hipocredit or Peachy or Express Credit Namibia, or maybe I'm wrong about some of them.
The only of those which so Express Credit is part of Express Credit Group, so it should be caught already by either International Accounting Standard 24 or by equity overlap. So there is equity overlap. Peachy, there's no equity overlap, and then Hipocredit is overlap because me and other Martins, we have a few percentage of the Hipocredit, right? So our threshold, which we follow, is that anything above 10%, which is usually considered kind of at least some threshold from which you start to count, then we put this equity overlap when there is more than 10% in both companies. So for us, for instance, in Mintos, so me and Martin, the other, we have more than 10%, but then in Hipocredit, we have just a few percent. So we don't consider that as an equity overlap according to the definition we use.
2019 report. So there was a comment that again about these related parties, and that some of them are controlled by the same person who has significant influence in Mintos. And I guess then all these that are mentioned here are when you account for these companies in this financial report, you are there talking only about those that have very significant overlap. So only those IAS 24, right?
Exactly. So our annual reports are created in accordance to international reporting standards. So we report and those where it is called by international accounting standards. So that would be only those which are IAS 24, and that's only a few of them, and that's why you would see there is much less revenue than when we look at the where there's equity overlap. So for instance, with Mogo, it is not according to IAS 24 related party, but there is some equity overlap, and Mogo is obviously quite a big client of ours, and then well, they take actually like a reasonably significant percentage of our revenue. They make it reasonably significant.
Well, yeah, so that was my next question. So according to the same report, so these related loan originators paid only 3.6% of your total income in 2019. So that gives an impression that they have much lower fees or don't pay, or maybe some don't pay any fees at all. So is that true, or how can you explain it?
It's so all the fees are the same for any of the loan originators. So it's the only difference will be that for those loan originators which are the bigger loan originators and they have more loan supply with us, we charge a lower fee. So there's basically call it a discount once you go up in how much you have funded through Mintos. So when we look at at our revenues, so we have around what we would call affiliated lending companies, so those would be where there's this IAS 24 or there's equity overlap, and there's actually just a few of them. So it's actually Mogo, Sun Finance, Express Credit, and then Zenka. And well, it used to be also Finco and Finitera, but they are kind of winding down. So all those affiliated companies, so today account for, or in 2019, they account for about like 40% of our revenue, which again is, I guess this is some of the misconception which we see flying around, that like all the lending companies on Mintos are related companies or affiliated in one way or the other. Yes, there are a few, and if we take 40% of the revenue, of course that sounds significant, but then again, like 20% of total revenue is Mogo, which is one of the largest lending companies, which is on the marketplace with about 85 million of portfolio funded. So it's a like significant part of the total portfolio. But if we count the numbers, so it's basically today we have this, well, basically 4 lending companies which are affiliated, and then you have 55 which are not affiliated. So it has to be put into the context. So this notion that like all the companies are related is perhaps not true.
Well, all not, but then 40% of volume, so it's almost half, right?
Sure, but of this 40%, you have to, if you take like Mogo is a big one, so 20% is Mogo, and then you take Sun Finance, which is another like 10% or something of revenue, so that leaves you with basically a couple or a few lending companies where there's what we would call affiliated. Right?
Okay, thank you. And then I want to talk a bit about these loans receivables and this concept that has been advertised for years, that actually investing in Mintos is maybe better than in some cases holding bonds, and even if a loan originator would fail, then Mintos could go after these specific loans and would have rights to these loan receivables, right? So it sounds really good in theory, but in practice it doesn't seem to work so far. So we have cases like like Rapido Finance or Eurocent, which have been going on for years. And so what's happening there? So
I think well, it's actually the situations are different. I wouldn't say that it's not. I wouldn't agree that it's necessarily true that it's not possible to do that. So, for instance, if you look at the Peachy case, so it's actually we could take over and not take over, but basically the recoveries went according to the plan. Likewise, if you look at the same Rapido, so actually we engaged the third party to actually take over the portfolio. So the third party in Spain, we found it, we actually initiated the process, but basically the Rapido was well, acting as it was acting and putting like obstacles for the third party, the debt collector, which was calling up the borrowers. Meanwhile, Rapido was calling the same borrowers and saying, no, actually you should not pay them, even though legally, well, they should. So I'm just basically like putting obstacles by the lending company. So you have to talk about the integrity of the lending company, if you will. Obviously, well, I mean, also the same Eurocent. So legally, and that's what we see with the Eurocent, but we also see many investors claiming that we should be pursuing much more strict legal actions, go to the courts. And Eurocent is a good example of what happens when you go to the court. So the Eurocent case, which we sent to the court, it's still in the court. It still has not been decided. It's been in the court like for 2-3 years. If you ask me, it's well not the best course of action when you go to the recovery. So even though you can enforce it, you can go to the court, it still takes time. And at the end of the day, well, the more time passes, the less perhaps you will be able to recover. So it depends on case by cases. For sure, in some cases, it's been like troublesome to get those recoveries going with the kind of structures we have. In some cases, it's been going rather well. In somewhere in between. So let's see how it's going to go with Alex Credit, where we are in the kind of process of taking over the servicing with the rest. So we still believe that the best service is a lending company, because they do have the relationship with the borrower. They know the process, and well, they are better at servicing. Sure, if we come to the situation such as with Rapido, when basically they are willfully kind of putting obstacles in front of it, so that doesn't work. So that's basically what I'm trying to say is like situation specific. I wouldn't kind of draw certain general conclusions.
Of course. I mean, it's situation specific, but my conclusion or so far is that if this company is not working together with you, if like it's acting in this way, like making obstacles or making your life harder, so there's not much then what you can do, right? So it's either try to make some kind of agreements with them, and if they are not friendly to you, then if you go to through this legal action, then it can take years and maybe recover much less or even zero. So according to yesterday's call, I think it was estimated that from Rapido and Eurocent, the expected recovery is 0%. So
yeah, those situations can happen. So I mean, as an analogy, perhaps I could use, for instance, in the bank. So when you take the loan from the bank and you put up the collateral or guarantee, so there's also not good mechanism for the bank to take over the collateral immediately and to auction it. So if the borrower or the client is really putting obstacles well for the bank to act, so it actually can drag for quite long process. So sure, legally you have those. Sure, for us as well, we can go through the courts. I mean, if you ask me, like for us, the easiest would be with every case, just go to the court and start the process. But what it's going to lead to, it's going to lead to lengthy process and much less recoveries, in our opinion. So this, while you have the mechanisms, so they are not. There is no mechanism where is basically you can initiate it and get results immediately. So it's
but what are the top issues? So I see, for example, in Estate Guru, so they are dealing with these failed borrowers all the time. They do these they sell these collaterals in, I don't know, 6 to 12 months or something like that. So So does it mean that now going after with this legal process with these short-term loans, it's much more difficult? So I was expecting that it would be the opposite.
It's not necessarily compatible, I think, to how you deal with a mortgage when you have a line on the property, and there is kind of good mechanisms that, well, you have a pledge and you can take over the pledge and like start acting immediately. So when it comes to the lending company, so for us, so one of the key assets of the lending company is portfolio. So for instance, with Alex Credit, yes, we can take over and we will take over, but that's takes time. So you have to find a third party, you have to do like 3-party agreement, you have to call up all the borrowers, you have to manage the cash flow. So it's just, I would say, not like completely different, but quite different process. So you cannot really compare the two. And then in this process, yes, it's gonna be kind of country risks when it's come to the same legal structures. So in some countries, the same Poland, which we saw, like this COVID shield is definitely not helping us. So there's just peculiarities of the specific countries and also of the legal framework. And obviously, if the loan originator or the lending company is not kind of acting in good faith, they get to find any ways to actually put obstacles, and we have to deal with them.
But assuming that there will be more cases where companies like put these obstacles and do not act in good faith, so but are they then really able to basically create such a bad situation where your recovery is 0%? So I don't really quite understand. So let's say in this Eurocent case, okay, maybe the courts and this legal process is slow, but if you still have this portfolio as collateral, right, or rights on this portfolio, so you should be able to recover, I don't know, 10% or something of that. Or so how is it possible that you, if this process goes through the end, that the recovery percent is 0?
I think in Eurocent is rather specific because it's a very small portfolio. So it's something like, if I'm not mistaken, I think it's around like 200,000 euros. So you most likely would not recover. Well, obviously the portfolio is already finished, right? So it's not outstanding anymore, most likely with the borrower. So they have collected something or not. So it's actually a very minor part which you can recover from that. And then, well, there are costs involved as well. So once you go to the court and so forth, so it's basically, you come down to very small recoveries. The longer it takes, the longer it's, I mean, in the same, if it's in administration, so the administrator going to take its charge and so forth. So there are things which are involved in that. So, but usually it's not the case, I would say, is that it's like 0% recovery. So actually, I would say.
So if you would have a bigger company, then the likelihood would be of higher percent of recovery.
I think the only cases is really like Rapido and Eurocent, which are more kind of exceptions than anything else. Where in Rapido, it basically was just a willful kind of putting on obstacles and really not acting with integrity. And then in Eurocent, it's just been a long process, and both of them are small portfolios. If you look at the other companies, so the same. Which we covered yesterday in the recoveries call. So there's definitely, for many of them, there are significant recoveries. For some, there's going to be less, but I don't think we have actually anywhere we say that there's like a 0% recoveries.
Yeah. Only these two were mentioned.
Yeah, so
0%. But there were several ones where there wasn't any estimate. For example, Capital Services, also from Poland. It has huge portfolio. And it also offered to Mintos like really ridiculous offer, right?
They did, and actually that's also what we explained yesterday. So we have introduced those disclosure levels, and that's for the reason that we have to protect our position in negotiations. So if we would put out, for instance, with Capital Service, the number which we expect to recover, then we might actually put us in a worse position, because obviously the lending company is also following what we put out there. So we are kind of answering them that this is a number what we work towards, whereas our number is like as close to 100% as possible. Right. So with those which are not cooperating, and when we don't have like that good kind of recovery negotiations, or well, they are not as kind of easy, we actually keep some of the information to us so that we don't really put the negotiations at risk, because obviously once you put all your cards on the table, so obviously the other party can take advantage of you.
Sure. Okay, let's move to another question. So again, a bit about related parties. So recently, Sebo was sold to Mogo, and it was mentioned in Mintos blog that the price for it was 2.9 million euro, and that part of it was sent to investors to cover Finco's group pending payments, but it wasn't mentioned how big is this part. Maybe you can comment on that.
I think this 2.9 actually was mentioned by Mogo in their kind of communication, but nevertheless, like 2.9 is the called like purchase price, but the net proceeds are much lower than that. So there were costs involved with the process, and they had to also cover the kind of equity part, which was necessary to meet the requirements. So the net proceeds, which actually Finco, or then us in a way, could get hold of, was much less than 2.9 million. But all of the net proceeds went to investors.
And how much was it? So it was like 50% or 10%, or like, I mean, if you say less than something, it can be anything. So it may be €1. So
I don't know by heart, but it was like definitely closer to kind of 10% or something. That it was a rather small part of the total purchase price. I mean, the thing is, was with Sebo, they were rather kind of a loss-making business at that time. So there was equity which they had to put in. So there was kind of structured deal which they put together, and then of that you have net proceeds which we can then allocate to investors.
I understand that this deal was done by these companies, like between Mogo and Finco, right? Or was Mintos involved there as well?
It's a very close involvement from our side, because according to our agreements, cooperation agreements with any lending company, to be honest, it's that we have to confirm or give approval when it comes to sale of certain share of assets, or well, in this case, share of well, not even share, but sale of the company. So we actually were involved, and we spent a lot of time discussing this internally. So should we approve it or should we not? Is it in the best interest of investors or not? And our reasoning was really that if you leave Sebo as a Finco group company, so it was basically kind of loss making at best, and we had a very unclear outlook when it came to COVID. So the COVID actually was impacting the Sebo significantly, and then because Finco had their problems, so there was a reasonable concern about if investors will actually fund the loans, right? So while as a business on asset side, it was could generate returns, on the liability side, it actually was at a very uncertain situation. So we would not know. So our assessment was, if we leave it as Sebo as kind of as a Finco, so we actually do a disservice to all of investors, both those which are Sebo, which have funded Sebo loans, and those which are Finco, in other Finco loans, right? So we estimated that the best, or concluded that the best course of action is really to sell it, to allow the deal to happen, even though if the net proceeds are small, it's still much better than to have Sebo, which is basically becomes another non-performing or winding down company, which we then put at the risk 15 million of loans which investors have invested in. Whereas if it's taken over by Mogo, so Mogo had at the time and still have like quite a bit of cash sitting on their balance sheet. It's obviously they put a group guarantee on top of that, so those investors which are at Sebo are like much better position, and also those investors which are not in Sebo but in other Finco group loans, because then at least there's no this kind of loss-making business which is dragging it even further down. And at least there are some, even if small, still proceeds which we can use to kind of allocate to other investors. So that was our thinking process about Sebo.
So in short, you were involved closely there and approved the deal.
Well, we were
So
significantly. So the deal required our approval. So and as with any other process, so we have a separate what you could call like committee, which is sitting there. So I definitely remember us like spending quite a bit of time. So there wasn't like clear-cut decision. So on one hand, sure, well, if the COVID outlook is not that uncertain and maybe investors still going to fund it, so maybe it's not going to be that big of a problem. So it can be profitable business, and then, well, that's for the benefit of those which invested in Sebo, but and also would be benefit so that we can, as part of the Finco group guarantee, to cover the liabilities which are of other entities in the group. But this uncertainty was too high for us to say, well, let's leave it as is. So we much rather said that, well, it's better that we don't put those 15 million at risk and allow the deal to go forward, and at least we get some proceeds from the deal instead of like basically dealing with a binding down company.
Okay. Then I've got one question about Mintos statistics and this interest earned. So in this page, you say that interest earned by investors is 120 million euro. And I wanted to ask, does it include all the interest earned also from these problematic companies, those that are suspended and maybe where this interest is kind of frozen and not really accessible?
Yeah, that's actually all interest which has been credited on investor account. So that's interest which has have been earned by investors. It doesn't include pending. It doesn't include in recovery and so forth. So that's actually actual interest which has been earned by investors.
Okay, good. And then one question about returns. So on your front page, you are showing a comparison between Mintos interest rates and then returns from assets like stocks and bonds and so on. And I think it's a bit misleading because in one case you are advertising like your interest rate, but not the real return that Mintos investors get after all the fees and all the money at risk that potentially might be lost. So I was wondering, like, have you calculated, or maybe you can estimate what is the real average return for an investor in Mintos after discounting all the cash drag, forex fees, secondary market fees, pending payments, and let's assume that 50% of money that is at risk is lost from these problematic loan originators.
Sure. So at the time when we were preparing the comparison, so that was based on the data which we had. So we didn't have much data about the expected default. So today we have, and I'm happy to walk you through how we come to that. So the easiest, the math is actually rather straightforward and simple. So if you look at the peak well, at the peak when we had in February, we had 600 million of the total portfolio, all active, all performing 600 million portfolio. Of that today, well, a lot of that portfolio actually has been already, a lot of that has been actually repaid to investors, so they have received the cash. So based on those 600 million, we still have 100 million, which is at risk or at exposure in recoveries, basically. So as you say, so perhaps we can expect that we recover, say, 40%, 50%. So just for the sake of math, let's take that we recover 40%. So you basically are looking at like 60 million capital at loss, and you have to divide it by 600 million to come to 10% capital at loss for average investor, which would be fully diversified. So basically you have 10% capital loss. So if you take that together with the 5 years or even 6 years we've been operating, when investors were earning 12% a year, 13% a year, and so forth. So, and you spread those 10% over the 5-6 years, so you're arriving at something expected default of like 2 to 3% a year. So if you take those 12-13% a year, which they earned in the first 5 years, and then you subtract 2-3%, then you arrive at something like 10% net return at the current situation. So that would be the math, and that's also something which kind of they have to put into the perspectives that there's timing issue when you invest. So obviously, if you started to invest just last year and you had a very fully diversified portfolio, so for each €1,000 you would look at the 100 euro capital loss, potential capital loss.
Yeah.
Might realize that, but say it's 100 euros. So
I think there is one problem with this calculation, because you assume that these investors, that let's say you account for 5, 6 or how many years that they were like making good returns and so on. But I think the average investor is not from 5 years ago, so he has been active. Like you probably got most of your investors in last year or last 2 years, right? So
sure, and that is this timing thing which I mentioned. So those investors we started last year, obviously they didn't have time to generate returns when there was not 2020 with all the economic downturn, all the kind of problems which we have had in the year. So obviously for them the capital loss will be well, on average it will be 10% of their total capital invested.
And
this is the same. I mean, this is the same as, I mean, when you invest in stocks as well. So if you would have invested in, say, I don't know, at the peak of 2007, and then you kind of try to make sense of what's the return on stocks at the end of 2008. So you would arrive at the conclusion that the stocks is perhaps minus 30% or something return, right? So
yeah, sure.
You have to look over the long term, and it's very hard to. So likewise, as well, it would not be correct to make assessment of how good the asset class, or what we provide the loans, are before the 2020. So it wouldn't be correct to say before 29 that, well, it's the best asset class, zero risks, like double-digit returns, like put all your money there. So it's not. So there are risks. Likewise, perhaps it's not a good way to look at the things like in a very short term and say that when you invested in 2019 and now you have like 10% capital at loss, that it's the worst investment ever. So it is, investing is a long-term thing, and that also applies to investing in loans. So you have to look actually perhaps over one business cycle, if not over like 2 business cycles, to really come to the real net return of the asset class. So that's the same as like at stocks. If you look for the same S&P, I guess over the last 60, 70 years, you have average return is about like what, 7%, maybe 7 something. 7 something percent. But then, well, you have some years where it's like super going like very strong, like now actually, when perhaps stocks are overvalued, as some people say. And then you have those downturns when they actually lose a lot of capital. So it's all equals out, and you have to look over the long term to really assess the true return of the asset class.
Well, I think the problem with this asset class is that most platforms won't survive like so long as Mintos, for example, 5 years or 10 years or 20 years. That's my assumption. Like seeing how many platforms like just have shut down this year alone. So it is, very risky class, at least right now, and a lot of speculation, a lot of fraud, and a lot of problems. But yeah, so maybe let's move to the quality of, let's say, your loan originators, and a couple of questions about them. About your Mintos Invest and Access product. So I've been quite critical about it, also about the diversification score that you plan to release. So in my opinion, so it seems like you are pushing investors into as many loan originators as possible. So you just want to bring the volume up, and it makes sense from business side, from like what you're doing, like building a marketplace. So you need a lot of loan originators, a lot of investors, and a lot of volume. But the problem is that if most of these loan originators are extremely risky and speculative, and we see that in right now with all the money at risk as well. My view is that you should not push these investors more into these risky loan originators, but maybe remove them from the platform. But maybe you can comment on this. So you think it's still a good idea to advise your average investor to invest in all of our loan originators?
So I would put it differently. So I wouldn't say that we push to invest in specific loan originators, but what we very much believe, and what I'm very confident about that, is that an average investor, like an ordinary investor, they should be fully diversified. So they should be actually, the best would be to diversify across all loan originators and kind of do the weighting based on how much the portfolio is funded through Mintos. So, and this is actually, we can come back to the example which we went through, like when Mintos had its peak 600 million, of which we perhaps are looking at 60 million capital at loss. So you're talking about 10% capital at loss. So any investor which invested fully diversified, they would actually look at the potential loss, 10% of the capital they had invested, had they diversified. Unless like an investor has a superior information, and that's actually goes, I think, similar again to the stock market, unless they do have superior information and they really believe that they can beat the market, like an average investor would be much better served just to diversify across all offering, because sure, they're gonna pick some which are not performing well, but they're gonna limit kind of exposure to each and every. Once you start to beat the market, and believes that you can beat the market, so you run into the problems that you perhaps over allocate to some of the lending companies, and then we see those cases where actually investors, and well, it is unfortunate, and that doesn't mean that we don't have to work on recoveries, and that's, well, it is what it is. But we see investors who have even like 50, 60, 70% maybe at recovery, whereas an average investor should have 10%. If you look at the numbers, so it's only like 60 over 600. So an average investor should be at 10%. So what we have a few investors which have much more than that, and they are obviously very vocal about that, and unhappy and emotional, and we understand. I mean, obviously, it's not, well, it is. It's still kind of a lot of money at the line. So, but then you have investors which have not lost or don't have any money in recovery because they were perhaps they were able to kind of call it beat the market, right? So they actually had maybe some good selection. And then the question comes down, do you really, as an investor, do you have superior information? And that's a question which each investor has to answer themselves. If they do have superior information, then, well, perhaps they can try to pick and select. Otherwise, an average investor should be, like ordinary investors, should be much better served by fully diversified portfolio. Because even if you have superior information, then you have to ask, I mean, would you be able to predict that, like, Kosovo gonna strip the licenses of some of the lending companies? Maybe you can, maybe you're not. Can you predict that there's going to be war in Armenia? Well, good question. Maybe you can, well, based on the history, right? Can you predict that in the same capital service, which was like one of the top leading players for 20 years operating in Poland, can you predict that the COVID going to come? They're going to be hit by that. There's going to be COVID shield and all this stuff, and it's not going to helping the company. Yeah, well, maybe some can, but if you ask me, like, actually, like an average investor perhaps doesn't have that information. And it's the same, I think, as with stocks. So there's only very small part of investors who can actually beat the market. All the rest are much better served just to go invest in ETFs and just take exposure to all of the stock market, which gonna include also some bad apples. So I think for the same, I don't know, this very kind of well-known case of Wirecard. Of course, if you invested in an index fund where the Wirecard was part of it, yeah, you pick up the Wirecard. Does it mean that you made the wrong decision? Not really. So you actually were diversified. So the key is what we are pushing is diversification, so that actually investors do diversify, and inevitably, well, that's just have to happen, that they're going to pick up some problem loans, and there's going to be some capital at loss, but at least it's going to be very diversified and it's going to be much more stable. So you're not going to have those fluctuations where we see those investors which have a recovery, like significant portion of the capital. And then, yeah, sure, you can have some which just made better selection and they were able to dodge those risky cases.
But I think there is one problem with this comparison with stock market, because in general, I completely agree that average investor should just pick an index like SP 500 or something in stock market. But in P2P, so we have an example. So this is maybe one example, but many bloggers like who diversified in Quetzal, Investio, Grouper, and like many frauds and scams and very strange platforms. So diversification works only if you basically invest at least in some minimal like quality companies, right? And all the companies that are listed in stock market, so they have some requirements. So they have to report either quarterly or whatever, but they have to provide financial reports of certain quality, and I guess they should be audited and so on. So there are some standards. Like I cannot just go and now list my €1 company in a stock market. So in P2P, it's different. So anyone can create a platform, anyone can list loan originators. And in case of Mintos, so I guess the issue is that you are picking up maybe those loan originators, and then many of them that have very low standards for reporting. Like many companies at Mintos don't have any financial reports at all, or are not audited, or are not audited by reputable auditors. So the same case is capital service. So yeah, they have long histories. They are operating for many years, but they don't even have a financial report in English. So it just shows, like, I don't know, lack of serious attitude to investors. That's like my opinion. So, and when you like collect like a big group of these low quality companies together, should you diversify among all of them? I'm not so sure.
I think I would divide that in two separate things. So one is, I would definitely argue that similar to stock market, I can agree about platforms which are outside of Mintos. Obviously, we don't have control over them. But similar to stock market, when it comes to Mintos, so you actually cannot put €1, like with €1 capital, loan originator on Mintos and start offering the loan. So there are quite a stringent minimum criteria which you have to meet. And on Mintos, it would be very highly unlikely to see like pure full-blown scam cases. Well, there might be mismanaged businesses. We might run in kind of very sophisticated kind of it's not really possible to have like scam case on Mintos, so if you ask me, right? So
okay, I'm not maybe talking in Mintos about scams, but just the quality of companies and quality of their reporting.
And that's where I would separate it into. So I would and definitely we can see that there might be kind of low quality reporting standards to some of the lending companies. So the same what you mentioned, like capital service. And that's their strategy. So they think that they should not, put effort to translate it in English, for instance. Some of the lending companies say that they are not ready to put out too much of information because they are afraid of the competition. And there are like multiple reasons why lending companies kind of can have low reporting standards. But that's also differs. So there are some which have very good reporting standards, especially those which are listed or have listed bonds on the stock market. So there's very good reporting standards. For some, it's less so. But basically, that should result in them being able to fund their loans at a higher rate. So that basically, because there's basically more risk involved with that. So investors should basically penalize them by asking higher return and not investing at the same, right? And then it's when it comes to the quality, that's I would actually argue that there is quite a lot of things which go into our process where there is actually a rather stringent level for the lending company to join us. So low reporting standard, what I'm trying to say, low reporting standards doesn't mean that they are low quality. So because, for instance, the same in Poland, so we receive all those reports. We receive like management reports and everything. We have a Polish speaking people, so we can kind of go through that. For investors, it's obviously a bit harder if they don't speak Polish, for instance, in that case. So in that respect, I would say that on Mintos, it's rather similar to stock market. You have to meet quite a lot of quality bar to actually be admitted to Mintos. So if you even look at the numbers which we have, like today we have on the platform about 60 active lending companies. In total, we have a relationship with something like 1,000 lending companies. Obviously, not all of them we would list and so forth, but we have said no to like hundreds of the lending companies, which we say, well, you don't meet the criteria. So, and that lets out those which are basically your €1 companies which were just created and they don't know anything about the lending.
But
and then I think when it comes to also
still companies with no reports, if they provide some info to you in some other way, it's fine for you.
We do, so that's the thing, that we receive much more information from the lending companies than we can put on in public, or more precisely, much more than they are willing to put themselves on public. So, and so they are all private companies, right? So they are not public companies, and they have to, well, they have a say in how much information they want as a private company to share or not. So what we advise to any lending company is the more information you provide, the better it is actually for you to the chance to actually get the loans funded, and presumably also at a lower rate, right? And also for the lending companies, what we receive are management reports. We receive them at least on a quarterly basis, and that's we obviously cannot show to Mintos. We receive the annual reports, and we speak different languages, so we can actually go through them. With those lending companies where there is bigger exposure, they actually have to get approval from us when it comes to auditor. So we ask them to have like at least big 4, in some countries top 6 auditor firm to actually audit their statements. So especially those where we have larger exposure, or which are larger. So that goes quite a lot of work from our side, which, well, some investors would be very interested into, but most of investors, I would argue, perhaps like 98% of investors would never really touch that information if we would put it out there.
Well, of course, they wouldn't touch it, but they kind of assume that you are doing your job, that you are actually doing this research, and that your standards should be high enough. And I'm not sure if they are so far, well, considering how many companies like now have run into issues. So, but you think that your process and this bar of your acceptance is fine, and that's how you will continue, or do you see any changes there?
It's always improving. So obviously it's, well, when we started and it was me, Dadar, Martinic, and a few developers, the process was very much different than it is today, when we have a separate partnership team, separate risk team, separate legal team, separate AML team. So the bar is like obviously all the time improving, right? I think the answer which we will be able to give is perhaps after another 5 years, once we have gone through the full business cycle, and then we can look back and say, okay, this is a net return or return which investors could generate given the risk level, right? So if after 10 years we come and see that the net return for investors was negative, then obviously we did a bad job on that. If we see that it's kind of reasonable, and now like after 5 years, 6 years, if we kind of calculate together, so if we see it's more or less like around like 10%, so I would argue that's a decent return for the risks they take. So it's hard to say now exactly like are we kind of we will be able to say only after a longer period of time to see what is a like a real return of the asset class.
Okay. Then so yesterday there was this call about each specific loan originator that was suspended, or there were some comments about expected recoveries, but like overall, like your estimate in next year or something, what do you see? What will happen? Like right now, there is about 100 million at risk from these risky loan originators. Do you think this number might go to 150 million and then to 50 or 10, or like any kind of feeling or estimate like what will happen?
So if you look at the current exposure, so we estimate that we will recover on average, or of the 100 million, we're going to recover something like 40-50%, but it's also highly dependent on, I mean, the same things which are happening in the world. COVID, of course, highly dependent. In the same Varks, which is actually having like 20% of those 100 million. So that depends also on the war in Armenia, which is by no means helping to collect the payments from the borrower. So there's there's a range. So it can go much better than that. We definitely don't see that we will recover 100%. Well, that's for sure. There's going to be some bad debt, but it also can be worse than like 40-50%. So it's still estimate which we can do now based on information what we have. So this is about like 40-50%. When it comes to will we see additional loans hitting kind of in recovery stage? So at the moment we don't see any happening in the we don't see any kind of brewing problems. Going forward, sure, there's going to be problems. What we don't see, we don't perhaps expect to see the same magnitude of problems what we saw in the March. And the thing is that the difference between now and March, even if the COVID goes on, is that in March, that was a shock moment. So in March, actually, what we saw is the liquidity dried out like significantly. It was basically like 1 week, investors investing 10 million a day. Next week, they're investing 3 million a day. So this liquidity crunch actually brought a lot of problems to the lending companies because they were not able to actually issue loans anymore, which means that the portfolios are decreasing. If portfolios are decreasing, that means that the revenue are decreasing. If revenue are decreasing and you couple it with increase in non-performing loans, then you end up with them not being able to meet the buyback, which they had to meet for the non-performing loans. So that's actually the shock brought quite a bit of difficulties, and that's what we saw why there were quite a few of cases in a rather short period of time, right? So actually, when we look now, the last real case when we suspended the lending company was in June, which is like 4 months ago when we suspended Cashwagon. So after that, I think we had the Finco Ukraine, but that's part of Finco, and then the small one, Jisatka, but that's kind of going rather well. So we don't expect in the future to have those. Well, you never know, but we don't expect to have these shock moments. So they're gonna be it COVID, be it just the regular business. Of course, when you talk about double-digit returns, you're gonna have those problem cases. So they're gonna pop up here and there, and that's why investors have to diversify and to limit exposure to any of those. Can you individually say which exactly gonna go into recovery if it happens? You cannot, but you can say on the portfolio basis, you know for sure that some will go there. You just don't know exactly if you look at the specific loan or specific country, what's going to happen in that country.
Okay. And then maybe you can comment a bit on Mintos as a company and your financials and the way you raise money. So you announced in 2018 that you have raised 5 million, but from your financial reports, I saw that these 5 million it was like a promise, a commitment, but the money was provided later in several parts. And I think the latest part was expected to be provided to you by September 2020. Is that correct? And was all the 5 million that was promised invested in company or not? How did it end?
So it's capital raising. So we raised it from call it angel investors. So the guys we kind of founded the company together. So, and we did it in tranches. So we didn't put all the money on the balance sheet. So it was kind of to be paid in, and we actually are getting it in tranches. So now we have something like 2 million cash sitting on the bank account. So it's enough for what we need to do. So there's no kind of point of having like more capital, not going to change anything for us. Those kind of smaller tranches. Having said that, so what we see now with the 2020 more or less behind us and with the situation starting to stabilize, we will definitely actually go out and we see a lot of opportunities ahead of us. So we see, with the help of the same licenses which we're going to obtain early next year, the electronic money institution license and investment firm license. So for instance, investment firm license is going to allow us to reach out to more investors in the current geographies, but also in the geographies where we don't operate today. So for instance, in France and Italy, we don't really do anything active because of regulatory uncertainty. Whereas electronic money institution license and the same investment firm also going to allow us to provide additional products. So we see a lot of opportunity. So we definitely are looking to invest in the development, and we will be looking to do fundraise. So you can actually expect some news on that from our side in the coming weeks.
You mean raising additional funding, or like?
Yeah, we would go out, and we are considering quite a substantial raise, which will allow us to scale the business further when the 2020, starting with 2021.
But this will be from some other parties or from the same investors?
No, from us, from outside capital. So I think we've been in a very good position that we have been able to raise capital from angel investors, which at the end of the day are also kind of co-founders or like the guys who started the company. So we haven't really had any outside capital, but now for the next stage, the capital which we are raising, looking to raise is more substantial, and it also doesn't make sense for kind of angel investors to continue investing. And well, they have only that much capital which they want to allocate to any specific company. So it's going to be outside capital for sure.
Okay. So right now you see no problems with money, and maybe even will raise more, right?
Yeah, well, we still generate decent revenue, so we have cut our cost base significantly. So we are burning a bit each month, but it's kind of sustainable. So we see the current situation stable, if you ask me. So, but obviously for us to put it into the next gear and to really scale it up and provide additional products, so we have to invest much more in the same product. Also, we want to invest more in bringing those lower risk, lower return loans on the marketplace, and just to widen up the offering, the same Mintos IBAN account or Mintos debit card, and then also providing additional investment opportunities such as the same ETFs on the marketplace. So those all things actually require quite a lot of investment, and that's what we see in the future for us.
Mm-hmm. So I guess then we can expect new loan originators as well, right?
Yeah, for sure. So we are already now working on a couple of loan originators. So it's the kind of the phase when we were focusing on the current lending companies. Well, we focused on them, but now we are back to looking to add new lending companies as the investments are picking up slightly, and we see that there's kind of investor appetite coming back, and investors also seeking for lower risk, lower return loans. So that's something which we will put on the market in the near future, actually.
So we can expect, I guess, different kind of loans. Right now, like most of your loans are consumer loans, right? Short term.
Well, there's not that many loan types left for us. So we have all the car loans which are secured. We have mortgage loans. So there's not much kind of loan types left. So it's going to be the same loan types.
But I mean, like in the sense of portfolio allocation, like 90, I don't know how much percent, but like really huge amount is these consumer loans, but like mortgage, real estate loans is very, very small percent of your.
Yeah, and that's partly the function of what we see in alternative lending space. So alternative lending space is predominantly about consumer loans. In some countries it's short-term, in some it's kind of installment based, and then other types of loans you just don't have the lending companies originating them. So for instance, the same mortgage loans we have in the Baltics, we had one from the Czech Republic, we saw like in Spain, But at the moments when we put them out on the marketplace, there was not that much uptake for the loans at 6-7% with a great loan to value originated in Prague or in Barcelona, which are perhaps bigger cities, right? So there's definitely what we can put, but at the end of the day, the offering which we have on the Mintos is going to be a mirror of the alternative lending space in general. So what is happening in alternative lending space?
So basically, your investors expect 10% or more to place into any loans, right?
That's what we saw before. So I think with kind of with the learnings which we have gone through, so I would expect that there will be more uptake for loans which are at the lower interest rates, but also significantly lower risks involved. So when you talk about mortgages which are, I don't know, with LTVs of like 40-50%, and they are highly liquid type of mortgages, such as the same, I don't know, flats or something which you can sell quickly, and they are not like huge mortgages, then that's actually carries much less risks than unsecured short-term consumer loan in more risky country.
And talking about these risky countries like Africa, Asia, Latin America, so has your view changed in any way regarding these countries or these places about the risk and possible recovery later if there are issues? Do you plan to expand more in these countries, or maybe the opposite?
You mean in the current countries do we plan to expand?
I mean, overall, do you plan to expand like a lot more outside Europe? Like I would consider like in riskier countries, like in Africa, Asia, Latin America, or your expansion is planned more on let's say, Western Europe or?
That I wouldn't actually necessarily agree that. I mean, we have to look on the country by country basis. So, for instance, the same Botswana, I think it's very kind of, or South Africa is actually rather developed countries even compared to some of the European countries. So it has to be looked on a country by country basis. Our expansion when it comes to the loan supply is again a mirror of what is happening in alternative lending space. So there is and was and will be a lot of activity perhaps in Southeast Asia. So we see opportunities there to bring the loan supply on Mintos. Likewise, of course, in Europe as well. The thing with Western Europe is that there is not that much lending outside of the banks. So most of the lending is done by the banks. And when you talk about the lending outside of the banks, so we are talking about like very low yields. So for instance, in Germany, we have had lending companies and captive banks which we have talked to, and they say, well, we originate loans at 4% APR, and we would be able to pay to investors like sell those loans at maybe 3.5%, 3.4% yield, which I guess today would be not, well, our investor base most likely would not be too keen in investing on such a low yielding asset. So as we grow, we perhaps going to get into even such low risk and low yielding assets, but investing in Europe, there's actually much less alternative lending happening.
Okay, got it. Well, I guess that's it for today from my side. I want to thank you for the call and answering and commenting on all the questions.
Thank you for your questions. As always, I think they are very kind of well thought questions, and whenever you have questions and for the investors, but also kind of when it comes to bloggers and so forth, so we are super happy to engage and have a discussion about the topics which are on people's mind.
Okay, then good luck with all the recoveries and expanding and raising more money. And
thank you,
maybe we'll talk in 6 months again or something.
Okay, happy to. Okay, Christoph. Thank you.
Bye.
Bye.